Well, welcome to today's webinar, which is a collaboration with Sharesies. Before we start, Brian will drop in the chat the house rules. The main thing to note is that we can't hear you, we can't see you, and so feel comfortable to just listen in. We definitely want to encourage any lots of engagement. So there are emojis at the bottom that you can click on and show us with your reaction. Feel free to drop in the chat your questions and any comments that you have as well. So with that, let's kick into this. So welcome to Clear the Air with me, Dr. Angela Lim. I'm CEO and co-founder of Clearhead, an innovative employee wellbeing platform. And so in August, we know that it's all about money, financial well-being. And this year's theme is about pausing and getting sorted. Since January 2002, our data have showed that the number of people worrying about their finances have actually increased by 70%. On top of that, we found out that the people experiencing financial anxiety, the most common thing they do is, nothing. And so with too many people feeling too overwhelmed to start, we really hope this webinar will be an informative place to begin. And when we look at our data, our second largest cause of poor mental health is actually people experiencing financial stress. So we really hope to be able to help you through that. So investing is one way in which you can proactively improve your financial well-being. And Sharesies is a wealth app that is created to provide financial empowerment for everyone. And we're really excited to collaborate with them on today's webinar. And so as part of the session, you'll learn about what investing is, what are the benefits, and many more. So this webinar is intended for a New Zealand audience, but you're still welcome to kind of stay on and listen through as well. So with that, I will pass it on to Susanna, who will introduce herself and take us through today's presentation. Welcome, Susanna.
Thanks, Angela. Kia ora, everyone. My name is Susanna, and I am the General Manager of Company Partnerships here at Sharesies. So what that means is Sharesies has been predominantly focused on our retail investors and building out a platform for people to invest in and to grow their wealth. But also we have an area where we partner with companies to help improve opportunities for everyone. So I lead that part of the business. I am going to share my screen and hopefully we can get in business. Great. So I am going to talk a little bit about Sharesies and why Sharesies was set up and what our purpose is and what we're hoping to achieve, and then also talk about some key investing concepts and leave plenty of time at the end for Q&A. So hopefully people are armed with some questions at the end, which is always really encouraged. So Sharesies is a wealth app, as Angela introduced, and our purpose is to create financial empowerment for everyone. We now have over 500,000 Sharesies investors, and collectively that equates to about $2 billion of funds under management. The way that we achieve our purpose of creating financial empowerment for everyone is by looking at how we can give someone with $5 and $5 million the same money opportunities. With Sharesies now you can invest in quite a wide range of different investments. We'll cover that later on, but that includes New Zealand shares, US shares and Australian shares. And then also more recently this year, we launched an on-course savings account with a great rate and no limits to make it easier for people to save money and also earn a decent interest rate on those well-earned savings. Also, keep your eyes peeled for our KiwiSaver product that is coming soon, that provides even more even more ways that you can have more choice and more control over your KiwiSaver. Sharesies is also a certified B Corp. A B Corp is an organisation where businesses that are part of it are looking at how they balance profit and purpose, noting that both are important. So Sharesies was started back in 2017 by 6 co-founders that covered quite a diverse range of skill sets. So the founders, some of them specialize in technology and engineering, also product design, marketing, finance. So, having 6 co-founders is probably still somewhat unusual, and that it's quite a large number. But the great thing about that is that it really covered a whole range of different subject matter expertise at that real foundational, at that founder level. The reason why Sharesies was set up was that at the time, it really felt like investing was quite unattainable and inaccessible for a lot of people. And the founders, they surveyed a wide range of different people across Aotearoa. And what they found is that there were many barriers that could be summarized in 3 different ways. So first of all, people were priced out. So at the time, you really needed quite a lot of money just to start investing, because many of the ways to invest had quite high minimum brokerage, so trading fee levels, as well as often high minimum amounts that you had to invest at any one time. And so what that meant is that often you needed maybe a few $1,000s to even get started. And for many people, that does represent a real barrier. So number one, people were priced out. Second of all, people were jargoned out. Like quite a few industries, I think the finance and investment industry is can be quite bad at using a lot of unnecessary jargon rather than using just plain English. And that creates barriers, other types of barriers for people that, we think is unnecessary. And so a key part of Sharesies is around providing, through the platform functionality and also through all the education blogs and the various things that we provide our customers, we really focus on that plain English and not using jargon where we have to. And if we do use jargon, then we explain what that means. And then finally, the other barrier that was, the other sort of key theme that was summarized in the research was that people were left out. And what we mean by that is that people almost felt like you had to look a certain way or be a certain sort of person or have a certain sort of job to be an investor. And that's not true at all. And we really wanted to break down that barrier, that actually investing is for everyone. Investing is a really important way for people to grow their wealth over time. And that needs to be available and accessible for everyone. And a key part of investing and growing your wealth is doing that over a long period of time. And so we want people to be able to know about investing, understand the benefits, and also be able to get started as soon as possible, rather than waiting for a long period of time until they have developed a certain amount of money or anything like that. So today we will cover a little bit of what investing is, why people do invest. So what's the benefit of investing, and cover some key investing concepts, and then also that Q&A at the end. Now, I do need to do a quick legal disclaimer, just to make sure that our legal team at Sharesies is happy with me doing this. So investing does involve risk. You aren't guaranteed to make money, and you might lose the money you started with. Any information that we provide is general only and current at this time. If you are looking for help with your investment choices, we recommend talking to a licensed financial advice provider, and we won't be providing any personalized advice as part of this session. So what I'm saying is general only in nature. Great. So what is investing? The concept of investing is really about making your money work for you. So it's really about investing money to potentially earn a return or make a profit on the money that you invest with at the start. There are lots of different ways that you can invest. Investing is often associated with the share markets, but it's much broader than that. That could include property, it could include bonds, which are debt instruments. It could include commodities like buying gold or silver or other metals. Sometimes you hear of people investing in artwork. I heard the other day someone investing in whiskey, which I find, an interesting one. But lots of different ways that people can be investing. And actually, for any of you listening that have a KiwiSaver account, you're actually already an investor because that money is being invested as we speak by whichever KiwiSaver provider you are with. So why do people invest? We survey our investors quite regularly around, wanting to understand what their goals are, because, what we're all about is we want to make sure that we're providing opportunities for people to meet their finance and investment goals. And there's quite a range of answers, which I personally find really exciting, because investing for me, it's not about the money per se, but it's actually the choice that it gives people. It's the opportunities that it provides for people, and that that's really exciting. So in terms of the different reasons of why people invest, that includes investing for retirement, which is a really big one. As we're living longer and longer, it's really important that we can have high quality retirements, and that does involve meaning that we are well set up for that. Also to potentially earn higher returns than on savings in the bank. We'll talk a little bit about that on the next slide, but investing does come with risk, but that also comes with the potential for higher returns. To feel financially secure, and again, that means different things for different people, but really, money can be such a strong form of stress, and so the more empowerment that people have around money, hopefully the better they're feeling about their futures. And when it comes to futures, not just their own future, but also their tamariki's future, and making sure that they're well set up. And then often it's about a specific goal too, like saving for a housing deposit, going on holiday. It could be if you want to start your own business one day and you want to quit your job, you might want to be investing for that and having money to be able to do that. So look, people invest for a wide range of reasons, and it is personal to each person. But I do think that one of the it really isn't about the money so much as the choices that opens up, and the freedom that it gives people, and the reduced stress that it can offer. So savings and investing, what is the difference? Really, it comes down to risk and reward. So when people put money into their savings account, it's ready to access for whenever they might need it. And the risk of losing that money, so the bank losing the money that you're putting into that account, is relatively low. And you might also earn a little bit of interest on it too, which is really good. Historically, though, over the long term, investment assets like shares and property and bonds have generated higher returns than interest on a savings account. But that comes with more risk. So what that means is that there is a greater risk that the value of those types of investments, like property and like the share market, tend to fluctuate more. And so there's a higher likelihood at any one time that they could lose some or all of their value. And that's why you might see your KiwiSaver balance go up and down more than your savings account at a bank. And that's why when we talk about investing and we talk about time horizon, we're talking about investing for the long term, because having a long-term time horizon means that you can withstand that greater volatility that some of those investments provide relative to cash in a bank account. We actually we don't view it as savings or investing. We actually think they go really well hand in hand. Saving is about putting your money aside to use later. And that's a really important part of financial well-being, having an emergency fund that you can dip into if you have unexpected bills or things that you need to pay for. And then investing is about making your money work harder for you. So it's about making money on your money and generating that long-term wealth over that long time horizon. And let's have a look at, what that might look like. So on this next slide here, this shows the power of compounding returns. So this is the idea of making money on the money that you put in, and then making money on the money that you made prior. So let's give an example. Let's say that someone invests $100 and they make an average return of 2% over the first year. So that's a $2 return. Then they reinvest that $2 return over the course of the next year. So they'd have earned another $2 return from their initial $100 principal amount that they put in. Plus they'd earn another 4 cents on that $2 return that they reinvested. And so all up, after 2 years, that investment is worth $104.04. So their money is actually making money. And that might not seem like a lot of money in that example, but over time, it can really add up. And that's the power of compound returns. Albert Einstein actually called it the 8th wonder of the world. And I really do find it, I still to this day keep getting blown away when I look at a compound return and just that real benefit of the especially in the latter years that those compound returns really adding up. And this graph gives you a hypothetical example of what might happen on a in a given interest rate by regularly putting away money every week. And the key sort of message that this graph is depicting is that the key thing is starting early. Like it's, we like to say at Sharesies, it's about time in the market rather than timing the market. It's really hard to sort of keep playing catch up if you just start later. So, we say sort of best time to start was yesterday, second best time to start is today. But really it's about giving you enough time so that in future years, that money that's getting made on the money you're making gets to be really, really impactful. So now let's talk about companies. So when people invest in individual companies, it's about owning a small slice of ownership in a single company. When you invest in shares, you become a part owner of that company, and that's what we call a shareholder. So when the company does well, after it's paid all of its normal costs that it has to do as part of being in business, it might pay some of the profits out to shareholders, and that's what we call a dividend. There's also another way to earn a return from shares, and that is by if you sell shares for more than what you paid them for, and that's what's called a capital gain. On the flip side, though, if the company doesn't do so well and the company's share price goes down and you sell those shares, then that's what's called a capital loss, and so there's a chance that you could reduce the money that you make as well. Companies that you can easily invest in are publicly listed, and what we mean by that is that they are listed on a stock exchange, so such as the NZX, the New Zealand Stock Exchange, or the ASX, the Australian Securities Exchange, and that's really a marketplace where lots of people can buy and sell shares. And that is quite different to private companies, where it would be quite hard to become an investor in that company. So if I give you an example, Auckland International Airport is listed on the New Zealand Stock Exchange. So anyone could sign up to a platform like Sharesies and buy and sell shares in Auckland Airport. However, Wellington Airport is privately owned. So that's owned by a company called Infratil, as well as the Wellington Local Council. And so that would be very hard for anyone just to become a shareholder in Wellington Airport, because you'd have to go to either the council and or Infratil and try and negotiate to buy some shares off them. So much harder for people to do. So now exchange traded funds, or you might have heard the term ETFs. So a fund is when a fund manager pulls lots of investors' money together and then invests it across a range of different investments based on some sort of style or investment strategy. And ETFs are a special type of fund that trade on an exchange. And like shares in a publicly listed company, they're usually designed to copy the performance of a theme or an index or a market. So, for example, there is an ETF that tracks the NZX 50. So that tracks the 50 largest companies on the New Zealand Stock Exchange. And they do this by buying a little bit of the companies that they're tracking and making sure that they own a bit of those 50 largest companies. So when you invest in an ETF, instead of buying a slice of a specific company, you're actually buying a tiny slice of loads of different companies. And so what this means is that one of the benefits of investing in an ETF is that it's quite an easy way to diversify your portfolio, which is something that we'll touch on soon. And then managed funds. So managed funds are another type of fund. They're a bit like ETFs in that there's a fund manager who pulls different people's money together to invest in a range of different investments. But unlike ETFs, managed funds aren't necessarily trying to copy a specific performance of an index. Instead, they're usually actively managing. So they're hiring people that are actively choosing which investments they're going to invest in, which investments they might sell, which investments they might buy. And they try and beat the general market performance and give investors a higher return. On the flip side, though, generally speaking, managed funds have higher fees than ETFs because they're having to employ people that actually make specific or more active decisions about what to invest in versus an ETF where there's generally a prescribed formula and it's just copying the index or copying a specific thing. But again, like ETFs, managed funds can be a great way to diversify and to spread your risk in a variety of different investments. Cool. So now let's look at some of the things that you might want to think about when you are investing. And I think the first thing is considering your financial goals. Are you investing to fund retirement or buy a house or something a bit more abstract, like just doing more with your money, financial freedom, or just learning about investing generally? And you might have multiple financial goals and they might evolve over time. But it is about knowing your why. So it's about knowing, what will you need or want money for in the future. It's about, what are you trying to achieve with your investment? How do you want to make money from your investments? So is it through getting, interest rate on bonds, or is it from getting dividends from companies, or is it about selling shares at a higher price than you bought them through a capital gain? It also is about thinking about what kind of investments might align with your interests and values. And this is a really big theme that continues to come up with our customers at Sharesies. And something that I find really inspiring is that more and more people are actually looking at, how they can make sure their investments align with their values. When we are buying shares in companies, we are really, we're supporting them, we're backing them, we're providing them with money. And so it's thinking about, well, actually, are these companies, are they working towards a better future that I'm more excited about? Is this a company that I want to go in and get behind? And I find it really inspiring that more and more people are doing this and going, how can I use my investments to ultimately create a better world in the future? And then how does this fit with your broader financial situation? So do you have debt? What other investments do you have? And how can what you're doing sort of support the other things that you've got or are in your financial situation? And having a rough idea on all these things will help you develop an investment strategy and also create, help you be able to stick with it. I find that when I'm really clear on what my goals are and get really specific on that and what sort of opportunities in the future they will unlock, then it helps me to stay motivated and helps me to stay really committed to the investment strategies that will serve me well for the future. So once you've set some goals, the next thing is to think about risk and reward. So all investing has risk, and that's not necessarily a bad thing, but it really is about getting understanding that and getting comfortable with it. The value of investments do go up and down, and some investments are riskier than others. And generally, higher risk does mean potentially higher reward. But that also means accepting less certainty. And the value of higher risk investments tends to vary more day to day than those with lower risk. So knowing when you're going to want to access that money is a really important thing to be clear on when you're thinking about what risk you're willing to take on. Because if you, as an example, if you think you're going to need the money in the short term, then you might want to be taking on less risk where there's less probability that the price is going to go up and down by a big amount, because your time horizon sort of doesn't allow you to withstand so much volatility. And on the flip side, if you've got a long time horizon, then potentially you can withstand greater volatility because you've got that longer time horizon to withstand all the highs and lows within that period. And that's why at Sharesies, we get really excited about making it as easy as possible for people to start as soon as possible, because the earlier that people get started, the greater time horizon they've got. I'm now a mum of 2 young kids, and I've got kids accounts for them that we just put in a very small amount of money, but every week into those 2 accounts, because I know that that way I can control a really long time horizon for them. They won't access that till they're sort of 18 or 20 years old. And by that stage, they've already got 18 to 20 years of investing that has been sort of being done on behalf of them, which I think is can provide a great foundation as they leave school and want to take on different opportunities that they might want. And time and risk are particularly important in the context of the current state of the share market. We've seen global share prices decline over the last few months, largely due to high inflation and the growing expectation that the global economy may slow down. And with high inflation, central banks will often have to increase interest rates, and then that makes it more challenging for companies and potentially brings down their share price. But what is really, in these situations where there is more share market volatility, it's quite important to stand back a bit and really look at it in the longer term context. Like historically, share markets have recovered from dips and trended upwards over time, and the up and downs are all part of the investment journey and what it means to be investing over the long term. On this graph, it's quite interesting because if you zoomed right in, you would see a lot of volatility going up and down. But as you keep zooming out, as you look at a longer and longer time horizon, then actually those volatilities look smaller, and you can see that strong trend upwards, which is what we have seen from globally from the share markets over many years. But within short periods of time you can get quite a lot of the highs and lows, and so that's all about why it's important to understand your risk tolerances, understand when you might need the money, understand how long you're investing for, so that you can make choices that are good for you. Another really important part of managing risk and managing the risk that comes within investing is about diversification. So we've all heard that phrase, I'm sure, of don't put all your eggs in one basket. And this is effectively what diversification is. It's about spreading your risk across many types of investments rather than putting all your eggs in one basket or all your money into one investment or a few investments. And what that means is that you're less likely to take a big hit if one of those investments loses a lot of money. There's many types of ways to to diversify. So you can diversify across different companies within the share market. You can diversify across different geographies. So, New Zealand, Australia, the US, other jurisdictions. You can invest across different sectors. So it might be the technology sector, the energy sector, the tourism sector, the banking, you have it. Also across different types of investments. So in shares and property and bonds and commodities like gold and silver, lots of different types of investments that you can also diversify across. You can also invest across size of company, for example. So often the larger companies might be more mature and more steady state. Smaller companies might be growing more quickly, but come with higher risk. So different ways to diversify also across size. So if we take a couple of examples around how this could play out. During the pandemic, there were some companies that, as a result, were quite negatively hit. So, for example, tourism companies where different countries shut down, the share price of investing in tourism companies would probably have reduced quite a lot. So, if you'd put all your money into tourism companies, you'd probably be very, very negatively affected in terms of the value of your investments. On the flip side, there were other companies that, from a financial point of view, really benefited from the lockdowns. So, for example, video conferencing software like Zoom would have done really well. Lots of different technology companies that were used a lot. Food delivery companies that meant contactless, that could comply with the no contact constraints that were in place would have done really well. So if you had invested in lots of different things, then you would have been, not so negatively hit versus if you had invested, only in tourism companies or in airline companies or some of those companies that were particularly badly hit. On the flip side, if you had only invested in companies that did do really well during that pandemic or during the lockdown periods, then you would have done especially well. But that just does come with more risk because it is harder to choose. No one knows the future, or I'm yet to meet someone that does, and so it's it comes with more risk if you are, choosing only a few investments that you think will do really well versus spreading that risk around across more investments. The core satellite approach is one that it's a method that I really like and I use quite regularly. And it basically puts diversification as a strategy into practice, but also, allows people to have some more fun around choosing particular investments. So basically, the core would be the investments that you're going to make sure are well diversified. So, for example, the majority, that core might be invested in funds or managed funds or exchange traded funds or some sort of diversified approach. And then that satellite or the smaller portion of your investment portfolio, you might choose to invest in a few different companies that you think are going to do well or you really want to support and get behind. But basically, it gives you a bit of both, where you're still, making sure that the bulk of your investments are, protected through that diversification strategy, while also allowing you some investments to more choose, a few different companies that you think will do well or want to get behind. So due diligence. Due diligence is really doing your homework. So this can mean lots of different things to different people. And I think it's quite personal around, what sort of homework you want to do on companies or funds or what you might be investing in, and to help you make that decision of whether to invest or not. There are lots of different ways to do due diligence, but it can include Googling a company or reading up on their annual reports, which are reports that they provide each year on the performance of the company and how they're tracking, and sometimes they give guidance on the future as well. It could be making sure you understand their strategy. You might look at who's comprises the management team or the board of directors, and you might look at their track records and see how they performed in the past. Some of the questions you might want to ask yourself is, what does the future look like for the company? So if you look at the products that they're making or the services that they're delivering, how optimistic are you that they're going to be doing well in 10 to 15 years time? You might ask yourself what the risks are with that particular company or investment. So what are the headwinds that could make it hard for them to achieve their objectives or goals? You might have a think about what the impact is on the world. So, for example, in the energy sector, are they contributing to a more sustainable future? Are they helping us to decarbonize, or are they actually increasing that carbon load? There's no right or wrong way to do due diligence, a tongue twister, but it's really about just gathering the information that is important to you and then deciding whether it's the right investment for you. The next thing I'm going to chat through is dollar cost averaging. This is something that I get really excited about because I often find with investing, if you really focus on trying to go, I want to get my investments for good prices and when's the right time to invest, I get quite anxious and stressed out about this because, no one does know the future. And so you never know whether, am I investing at the bottom, or could the share price go down further, or, when is the right time that I should be starting to invest? And that just becomes quite stressful trying to answer some of those questions. And so dollar cost averaging is a technique that basically allows you to not worry about trying to time the market. And it's really about investing a regular amount of money into a particular investment. And you just keep doing that over time, regardless of what the share price or the price of those investments are doing. And the beauty of this is that when the share price goes up, then that's good news because your investments are increasing in value. But when the share price is going down, then you actually get more shares for that regular investing that you're doing. So you're almost sort of, getting them at a better price than when they were more expensive. And so this gives you an example of it, but of how the share price can fluctuate. But if you're spending $100 every week or fortnight or month or whatever period you're investing over, then you'll be buying those shares at different prices. And so when the price is lower, you're actually buying more shares. And when the price is higher, you're buying less shares. And so over time, you're smoothing that price you're getting, and you're not really so worried about trying to choose or time the market. This is an approach that I use, and it's an approach that I use with my kids as well, where I just put every week a certain amount of money goes into some investments that I've selected, and then I'm just not so concerned around trying to work out when I should be buying the shares. Cool. So just a little bit of a recap around what we offer on the Sharesies platform in terms of the opportunities to grow your wealth. So we offer over 8,000 companies and funds on our platform. We offer access to the New Zealand Stock Exchange, the Australian Securities Exchange, and also the US share markets, which includes the NASDAQ exchange, which is where a lot of the technology companies are listed, and also the New York Stock Exchange, where a lot of other large companies are listed as well. Auto invest is a really key feature of our platform. So that is really a lever to help you dollar cost average. So it's about set and forget, set it up, a regular payment from your bank account to your Sharesies wallet, and then your Sharesies wallet auto investing into any investments that you pre-select. We offer kids accounts, which is something that is really important to us to make sure that we're making it as easy as possible for people to start investing as early as possible. I think our youngest investor we've ever had on the platform was about 7 or 8 days old, which having a mother myself now, I just find it inspiring that parents were so organised to have an IRD number for their baby and to set them up so soon. But yeah, again, the earlier that people can start, we think the better. No minimum investment, so you can invest with literally as little as 1 cent. Really low transaction fees and monthly plans. So again, really supporting that regular investing and making sure that people can develop good investing habits that will set them up well for the future. We've got great investor support. We've got a great investor care team of people that are really well set up to make sure they're answering any questions that people have. We invest a lot in education as well. So we have learn articles. We've got investor stories on our website that people can read up on. We've got a monthly newsletter. And we also have webinars, which is where we get CEOs or management of different listed companies, and we will interview them on our webinar Shared Lunch, which is a great way for people to learn more about companies that they might want to be investing in or are already investing in, and really getting access to management who are running the companies. We've also got a Share Club Facebook group where people can, share different insights and discuss their investments, which is really great. A lot of really active community there. And we've also got our Sharesies Save product that we've launched at the start of this year, and also our Sharesies KiwiSaver scheme, which has had a soft launch, but we'll be expanding on that in the coming months. Before I break for any Q&A, one of the questions we often get is why the pineapple? And I thought I'd just give you a quick explainer on why that is. So a pineapple is our sort of symbol that we use all the time. So back in the day, pineapples were really a sign of wealth and prosperity. They were really expensive. They were pretty unattainable, unaffordable. People often would hire them out for their centerpieces in their tables, never eating them, but again, that real sign of sort of luxury and royalty and wealth. And now you can, pineapples are very, very accessible. You can even buy them chopped up in a can. You can buy them at a fish and chip shop, all sorts of places. And that's really, how we like to think about what we're doing in the wealth space, is really democratizing all the opportunities for people to grow their wealth so that anyone can get access to those opportunities. Alrighty, that is me. I'll hand back over to Angela, and if there is any questions, I'd be really happy to answer them.
Amazing. Well, thank you, Susanna, for taking us through that. Very engaged chat going on in terms of some of the stuff that you've been educating, and obviously something that we want to make sure that our children and the next generation are really able to do. So look, I think what's really sort of key and top of mind for a lot of people is interest rates have gone up. And that means what used to be cheap capital for buying property, whether it's investment or property or your own home, that's something that people are now having to think twice about. And, a key question between that is basically, when do you kind of go, well, the interest rate's going up, so I should pay down my mortgage loan as quickly as possible, versus taking that same amount of money to invest in shares, for example. So how would you sort of advise those who are like thinking about the duality between paying down the mortgage or taking that same amount of money to invest in shares?
Yeah, I mean, that's going to be a personal decision. So it's sort of really hard for me to be able to say definitively what people should do. It's what I would say is that on investing, the big thing that we encourage is for people to be investing for the long term. So thinking about a long-term time horizon, and also to be investing what is affordable for them. So the cost of living is, really tough at the moment. For people that do own houses and have a mortgage, then that is, people are refixing their mortgages and their mortgage payments are increasing significantly at the moment. Investing is, we really want to encourage people to be investing what is affordable. In terms of the choice around, do I then try and pay my mortgage down quicker, or do I, stick to investing? It's just going to be a personal decision around what sort of risk reward people have, the time horizons that they're looking at. But what we do see across our investor base is, people that can be regularly investing over a long period of time are the ones that are going to be doing really well. The other thing I'd say is that when share prices do go down, that does represent a great buying opportunity, and it's hard when when we're in a situation like we are at the moment, where share price is down, which potentially represents a great buying opportunity, but yet because people are experiencing greater cost of living, greater mortgages, then it's really hard to sort of have that spare change to invest and take advantage of those opportunities, and that does concern me, because I think that potentially exacerbates the wealth gap, where you get people that do have a lot of wealth that can really take advantage of these times when share prices are lower, and we want everybody to be able to take advantage of those potentially good buying opportunities.
In the context of those buying opportunities, you mentioned that obviously, just because you're based in one country doesn't mean that you can only invest in shares in that country that you're in, that you can actually invest in other countries' share market. And obviously, for example, the New Zealand share market is quieter and more stable than the American share market, for example, in terms of volatility. So when thinking about that risk appetite and the level of rewards, how would you look at the different share markets and where to invest in?
Yeah, we're seeing that at the moment, but that can change. So that is where that diversification is important, and being able to diversify across different jurisdictions. It is true that in New Zealand, in the New Zealand stock exchange, typically we've seen it favour companies that pay dividends, so are probably lower growth, lower volatility, and are companies that are more steady state and pay out regular dividends. So the big companies that are listed on our local stock exchange tend to be companies like the electricity retailers, like Meridian Energy and Mercury and Genesis, big telcos like Spark, big companies like Auckland Airport, sort of big infrastructure companies, and so those companies are they do tend to be sort of more steady state. When we look in the US, some of the really big companies might be in the technology space or other areas where there is possibly higher growth with higher volatility. So I would more say it's about understanding that risk profile that you've got, and then making sure that you are ideally adopting including diversification in that strategy. The other thing to think about with investing across different geographies is also taking into account exchange rate risk as well. So, for example, if you're investing in companies that might be listed on a US exchange, then they might, they're probably making their money in US dollars. So, if the US dollar strengthens against the New Zealand dollar, then that could be good news for you. But on the flip side, it could be the opposite too. So it's also about thinking about that, the exchange rate risk as well when you're diversifying across geographies.
Awesome. A large part of, democratizing financial literacy is not using jargon, and a couple of jargon that came up that would be good for you to clarify. One is, what is an ETF and what is a DCA?
Yeah. So an ETF is an exchange traded fund. So what that means is it's a fund that pulls different investors' money together. and they invest in a particular index. These indexes could be based on the size of a company, but they can also be based on thematics, like, ESG or water or technology. So a few ETFs that people might have heard of is the NZX 50. So that ETF invests in the 50 largest companies on the New Zealand Stock Exchange. So it invests a little bit in Meridian Energy and into Spark and into Air New Zealand and into the 50 largest companies. Also, there's the ASX 200. So that invests in the 200 largest largest companies listed on the Australian Securities Exchange. So they'd be investing in companies like Westpac and NAB and ANZ, so the big banks. Some of the other big companies in Australia like Woolworths. And then also there's the S&P 500, which invests in the 500 largest companies on US exchanges. So they'll be investing in in Alphabet or Google, and Tesla, and lots of different large US companies.
And do you know what is the DCA?
DCA?
Yeah.
No, I don't know what do people mean by the DCA?
Not sure. It was in the chat, but okay, let's move on then. It doesn't.
Sorry.
There you go.
Right, cool. Sorry, I just don't think about it as DCA. So dollar cost averaging, and apologies if I didn't make that clear, but dollar cost averaging is about investing a fixed amount of money regularly in the same investment. So I'll give you an example. I'm going to invest $20 every week that goes into the NZX 50 ETF. So every week, $20 of mine goes into the 50 largest companies on the New Zealand Stock Exchange. And so the thing about this strategy is that if the NZX 50 value goes down, then I buy more shares because my $20 will be able to buy me more shares because the share price is lower. And then if the share price is higher, I get to buy fewer number of shares with that $20. But I'm also happy because then my investments that I've been investing into the NZX 50 are worth more because the share price is going up. So it's, I think, a really great strategy in terms of taking the anxiety around trying to time the market. And instead you just go, look, I accept that over time share markets go up and down, but hopefully over the long term they're increasing in value. And so I'm just not going to worry about when they're low and when they're high. I'm just going to invest the same amount of money into an investment and know that when the price is high, I'm buying less, when the price goes down, I'm buying more, and over time I'm dollar cost averaging.
That sounds good. So I think it's important for us to kind of caveat that obviously we love to partner with Sharesies, but there are other providers out there. But in the context that if you do choose to go ahead with using Sharesies for sort of improving your financial situation, there are a few questions that we have that I think will be good for you to clarify, Susanna. So the first is, if Sharesies goes under, what happens to investors' money?
Yeah, it's a really important question, and an important question for people to be asking. So what we do is we provide a custodian model. So we have a separate entity that is completely separated to Sharesies Limited. And that separate entity holds our investors' money and shares. And so if Sharesies, the company, goes under, then that entity remains untouched. It can't be touched from us, and we take that very seriously. And so then if we went under, then those investments in cash would be just returned to the beneficial owners, which are the customers that hold them. And that entity is audited every year by an external audit. We also have, as an NZX market participant, we have a regulator, NZ Regco, come on site and do an annual inspection. And so it's, that's our custodian obligations. We take very, very seriously. And then there's also a whole bunch of controls around that to make sure that, and customers' assets are fully protected and are fully separate from the Sharesies Limited, the trading company that that employs people and builds technology and does all those other things.
And I think it's really important that regardless of who you choose, you ask that question.
Yes.
So, for example, the high-profile issue obviously was with FTX around the cryptocurrency, and investors lost all their money because there wasn't that separation. So, if I do invest in shares and Sharesies, how liquid is it that can I withdraw funds whenever I need, or does it get stuck there? For example, like Bitcoin.
Yeah, so we connect to the exchanges. So when an investor places a sell order, we will just put the sell order to the exchange and wait for it to be filled by a buyer, because the exchange is really just the marketplace, and you need a buyer and a seller on both sides for shares to be bought or sold. For really big companies, they're very liquid, which means that there's lots of buyers and lots of sellers. So if we were selling shares in, I don't know, ANZ or a big company like that, then they tend to get filled straight away. There are some really small companies, and they tend to be less liquid. And so what that means is that there's just not many buyers or sellers because they're such a small company. And so sometimes that can actually take more than a day to fill. But the majority of companies, are liquid, and so the order can be filled, pretty quickly after placing the order on the exchange. And then in terms of withdrawing money from the Sharesies platform, it's getting quicker and quicker. It generally happens same day, but can take up to 2 days maximum to withdraw money from the Sharesies platform and into your bank account.
That's great. And I know that obviously Sharesies have a strong social mission, but ultimately you're still a company. So it'd be good to understand in terms of how you actually make money through investors investing on your platform.
Yeah. So there is a few ways. So the main one is through brokerage fees and currency change fees. So, for example, when someone places an order to buy a company on the New Zealand Stock Exchange, then we will charge a small transaction fee on that order. That is it varies depending on the exchange. But I think for the NZX, it's 2% brokerage, but up to a maximum of $25 New Zealand. So you won't pay any more than $25 on a specific transaction, but 2% on smaller amounts. I think that the US markets, it's kept at $4, and the ASX exchange, it's kept at $5. Don't quote me on that, but I think that's right. And then we also have monthly plans as well, so subscriptions. So for people that are regularly investing, that can be a more economical way to do it as well. There are a couple of other ways that we do make money. So one is for investors that have got cash in their wallet but haven't invested in it in something, we do make some interest on that cash. But now that we've got an on-call savings account, what's great is that investors actually can, if they've got cash sitting in the Sharesies wallet, they can just put it into the save product on Sharesies and be earning, I think at the moment it's 5% interest rate on that, which is fantastic. And then the one other thing is on managed funds and exchange traded funds. We can sometimes get not all of them, I don't think, but we sometimes can get a small rebate on them from them if we take out of the management fees. So it's investors don't pay any extra, but it's just that those fund managers basically give us a small portion for the fact that it's Sharesies investors that have come into that particular investment.
That sounds good. And so just to clarify, can I only invest in secondary shares in the share market, or can we also participate in, sort of IPOs or initial public offerings on Sharesies as well?
Well, I'm so glad that this is actually my favorite question because as the in my role in the company partnership space, this is what I work a lot on, and that is partnering with companies around their capital raising initiatives. There actually hasn't been very many IPOs in the New Zealand market for quite a long time, but there has been quite a few high profile capital raises, and this is where companies still raise new money, and we've been really thrilled that we can offer most of them to our Sharesies investors. So recent ones were Infratil when they raised some money, Ryman Healthcare, ANZ Group did one last year, and also Air New Zealand did a really big one at the start of last year as well. But yeah, that's a really important part of our offering at Sharesies, is making sure that when companies are raising more money, or companies are listing on the exchange for the first time, that we can offer access to investors. Particularly when companies are already listed on the exchange and are raising more money, often that's done at a discount to what the shares are typically trading at. And so that's a really important way for people to be able to grow their wealth. So really important that we can make as many of those opportunities accessible to everyone.
Great. One quick final question before we close off today's session. What is the general basic tax implication for investing? Whether it's $5 or $50,000, and obviously earning dividends on that. What's the tax implication for that? And we'll close off with that last question.
Yeah, sure. So it depends on a few things. It depends on what market you're investing in. It depends on whether you're a New Zealand resident or not. And it also depends on whether you're more of a habitual investor or if you're a professional investor, and that's your day-to-day job is trading, buying and selling shares to make a profit. But we've got a lot of great help center articles on our website that will, that people can read through. But what I will say is that we try and make sure the tax component is as seamless as possible. And so where possible, we will pay tax on the investor's behalf to the IRD in New Zealand, or if it's an Australian shares, the ATO, or the tax authority in the US on US shares. Just so that people don't need to be stressing out about tax. And so in New Zealand, for a New Zealand resident that is not buying and selling shares as their professional living, then dividends taxed, but we don't have a capital gains tax in New Zealand. So yeah, we will, when we're paying out dividends or those sort of returns like that, then we will pay the IRD on the investor's behalf. But what I would say is go and have a look at our Help Centre articles, because they are beautifully written by our content team that's far better at describing some of those things than I am.
Amazing. Well, thank you, Susanna. Obviously, lots of people found this session super helpful. Remember, these is not personalized financial advice. If you do need that, and Clearhead is your EAP provider, we do have financial advisors both in Australia and New Zealand that you can tap into. But otherwise, we wish you well in creating wealth and your financial well-being, and taking steps to reduce that financial stress that you're in. So thank you so much, everyone, and take care and goodbye.
Thank you.